Hey there, everyone. Today on the final bar, an initial rally after the CPI number this morning met with additional selling. The S&P closing back below 4,500. We'll talk about one key group in the industrial sector feeling the pain this week. Also, we'll be talking with Mish Schneider of MarketGauge. Is it time to look outside the U.S.? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Very happy to be back here home in a sunny Redmond, Washington. Thanks for joining us every weekday after the close for our show. Thanks for hanging with us this week as we did the show remotely from the Money Show in Las Vegas. Good to be back home in the cooler and somewhat rainier weather here in the Pacific Northwest. Good to be back in our studio and continue to cover the markets every trading day, every day after the close. You know, interesting day today, I feel like, among many. A lot of anticipation, expectation coming into today's CPI number. The next Fed meeting is another month plus out in September. So we're going to have another reading from the CPI in September before the next Fed decision would be announced. Overall, what was the anticipation? Well, a little bit of optimism, particularly right out of the open, right? A nice sort of additional rally. But what's, I think, very telling is as the day progressed, that initial rally was met with selling. And through the course of the day, there's more sellers than buyers, I guess, anecdotally. The S&P, the NASDAQ finishing at the lows of the day. So while the S&P finished just slightly positive, I'm talking a rounding error positive, I think the trend going into the close from after the first 30 minutes on tells you a lot about the overall sentiment right now in the markets. A lot of great charts to cover and a really good guest. Mish Schneider always does a great job bringing some charts and helping us think about how today's movement is fit into sort of the big picture and the evolution of these trends. And let's get right to it and go to our market recap. As a reminder, we're going to do a poll here to start out with. We always have polls running on our social media accounts. Make sure you subscribe to our YouTube channel. Give us a follow on Twitter and elsewhere. And we asked you recently, does the S&P 500 make a new all-time high before year-end 2023? Simple question, yes or no. Not so simple of an answer, though. 57% of you saying yes, the S&P does get above 4,800 plus. Only 43% saying no. I will be honest, I'm somewhat surprised by this answer. I would expect a little less optimism after this retracement here in the last couple of weeks. What this tells me is we're all sort of pricing in. I think now the market is sort of realizing, or I guess accepting the fact that we're in a bit of a pullback phase here. We've seen that in the charts of Apple and Microsoft. We're now seeing that magnified in other areas of the market. While there are certainly some pockets of the equity space doing quite well here, the growth leadership has started to struggle a little bit. Those charts are really going to have to turn around here to get the S&P to new all-time highs. Now, the reality is that we have a lot of runway left, right? We're here in mid-August. We've got quite a lot of time until December 31st, and certainly a lot can happen between now and then. What's interesting is if you do see the S&P making a new high, and you also accept that we're in a pullback, now it's all about sort of that tactical game of recognizing when that pullback phase may be nearing an end, when you want to start to accumulate and ride that potential move to new highs. I am certainly happy being patient and letting the charts tell me when that distribution phase is in place, which I think it is, and when that distribution phase is over. And as I think we'll see from some of the charts we're about to look at, I would argue not there yet. I would probably vote no in that poll. Very interested again. Thanks for answering that. Interesting to see some optimism from Final Bar Nation and from the Stock Charts TV viewers. Let's get to the markets today and see what happened. As I mentioned, sort of a big change from the first 30 minutes, which was a nice rally out of the open, to closing really more toward the lows of the day. If we look at the S&P 500, basically finishing the day flat, but it was not just a non-factor from yesterday's close to today's close. There was a lot of movement, sort of an inverted V shape to today's trading. Again, nice rally out of the open. The S&P closing just below 4469, and again, that's right about where we closed yesterday's session. The Dow and the NASDAQ up again just briefly, but just slightly. Overall, this is a day that ended unchanged. The NYSE composite almost to the penny flat from yesterday's close. Mid caps and small caps slightly down. The small cap S&P 600 down about 0.4%. That was the worst performing out of these major North American indexes we're tracking here. The VIX coming off just a little bit as well, down below 16, just sort of slightly different from where we were yesterday, right around 1593 going into the close. Looking at interest rates, we've talked about a rising rate environment, how that I think could be certainly part of a big part, a non-small part of this story of rotation away from growth leadership and into some of the cyclical sectors like energy and others that have done quite well as the growth sectors have been struggling. You're seeing further upside in rates today. The 10-year yield pushing a bit higher, just below 4.1%. Long bond yields, 30-year yields around 4.24, and the 5-year yield around 4.2%. So sort of that mid to long end of the yield curve all pushing to the upside today. As bonds rotated lower, and one of the charts I'll be talking about with my guest today, Mish Schneider, looking at interest rates, looking at the bond markets, and what the implications may be going forward. So for what it's worth, the TLT finishing down about 1.7% today. Decent down day. The dollar index, not too much of a change from yesterday. The UUP, a bullish dollar ETF, was up about 0.2%. Commodities, a lot of sort of unchanged feel to things, although the DBC, which is a broad commodity ETF, finishing about 0.5% lower, just below 24.50. Gold and silver prices, not too much. Gold not too much different. Gold slightly down, silver slightly higher. Oil prices and natural gas prices especially moving lower. So while energy has started to really improve as a sector, energy prices today not really following through on the upside trend that we've seen recently. Finally, cryptocurrencies mostly in the red, not by much. Crypto's kind of rolled over during the equity trading session. Bitcoin just above 29,400, and that's up about 0.5%, or excuse me, down about 0.5% from yesterday's close. Ether prices just below 1850. That's down about 1/3%. Sectors very quickly, just to finish off. It's interesting, we've talked about this rotation away from growth and into cyclical sectors. Overall, that is the larger trend I think we're dealing with. Today, a nice sort of counter trend move higher on some of the sectors that have been struggling. The XLC and XLY were two sectors that actually finished in the green today. The consumer communications services up 0.4%, consumer discretionary up about 0.25%. After that, materials, financials, technology, all basically flat for the day, along with energy. Only a couple sectors slightly down. Real estate, utilities, industrials, all down about 0.3, 0.4%. So again, at the end of the day, not a significant move for equities. And what's interesting, and what I would say is, the absence of a big upswing after the CPI number, I think, is telling today, right? If things are really getting bullish from here, if this pullback in growth is over, you see a nice rally after the inflation data. That would be sort of a all clear, soft landing, no problem, things are going to get better. I don't think that's what the market is telling you by the close. This is more of an unchanged sort of still digesting this meal that we were just given this morning. Let's look at a chart of the S&P 500, just sort of see where things played out. And again, I think the larger theme we've been talking about is sort of the line in the sand approach. The way I like to approach a market like this, anytime you've had something that's had a really good run higher and you just start to roll over, it is very easy to get caught up into a consistent guessing game, right? Was that the bottom? Was that the bottom? Was that the bottom? Should I get defensive? Should I still own it? These are the logical questions, the common emotional reactions we tend to have when something has been going up and it stops going up. What I like to do is set what I call a line in the sand. What's that level? What's that signal? What's that point where you would say, once this happens, then the uptrend that I have been confirming is no longer confirmed. Something's different, what I call a change of character. For me, that level would be the 50-day moving average, also the trend line taking the March and the May lows. It's currently right around 44.30. Both of those same measures are right around that same point. If we hold that sort of level, I would say this is just another tactical pullback along the way of this great long-term uptrend we've experienced since the October 22 lows. If we fail to hold that sort of thing, again, what it doesn't mean the S&P is going to zero or going to retest the October lows, although that's possible, but it tells me that things are different. It tells me that the character of this market over the last 6 months is now changing and something is now new and different. And then I need to start thinking about further downside targets. I need to think about further downside protection, whether it's lightening up on positions, using protective puts or some sort of option strategy to try to, further or better define my downside risk and make sure I'm comfortable with that. But again, I think, instead of worrying every tick, if this is something you need to be concerned about, define that line in the sand, use a platform like StockCharts, use the alerts feature to tell you the S&P has now broken this level. Now you need to revisit your positions. And I would think of that with the broader market environment. I would certainly think about that with individual stocks and positions as well. Set alerts to identify those lines in the sand or compel yourself to take action when those lines in the sand may be violated. So for now, still holding. But again, given the macro environment and what I'm seeing on days like today and other days here in recent weeks, I think most likely we failed to hold those levels, and we'll be talking about further downside objectives here pretty soon. But I'll wait to see when the chart actually confirms that break of my own line in the sand. Now, I do want to mention I have a market trend model that I like to review every Friday at the close is when I lock in any updated levels. This is using our ACP platform to run the market trend model on large caps, mid caps, small caps, and the NASDAQ 100. And long story short, if today was the end of the week, if today was Friday and it was the close, all four of these, the short-term market trend model would be negative for me. They've all been bullish for most of the last 6 to 8 weeks, if not much further. Most of them turned bullish there in April and have remained in a bullish short-term read since then. The sell-off that we're getting this week is now starting to rotate these signals lower. The S&P's short-term model actually turned bearish on Friday of last week, and that's what I was updating all my followers on that. I think you're seeing further downside here and now mid caps and small caps potentially. Again, barring a big recovery tomorrow, which is possible, I think we're starting to see, again, further confirmation of this downside retrenchment for some of these major indexes. One of the charts that I have in my Mindful Investor Live chart list is a chart I simply called the chart. And again, this is something I created years ago when someone at one of my previous shops would always ask me, what does the chart say about blah, about the markets, right? In somehow trying to imply that I had one chart and that's all I did to sort of figure out what was going to happen. And so I created one chart with a bunch of different indicators and I said, here's my chart, here's the chart, and all you need to do is look at it. And what I found was it was actually really cool to have one chart that summarized some of the key factors that I think are important to follow. So once or twice a year, I'll update this chart and sort of rotate things out if I don't think they're being particularly helpful, add new indicators if I think they help me understand where things are at. This was the setting that I came up with at the end of last year, and I think it's been pretty good about helping me understand the overall conditions here. And what I wanted to do is just look at the trend up until the end of July and now what we're starting to see in August. The end of July, the S&P is making a new high for the year, and now in August, of course, we've rotated lower. Again, not the end of the world yet, but certainly rotating in the tactical time frame from an upswing to a downswing. This is the advanced decline line for the New York Stock Exchange. Common stocks only, just looking at the companies listed on the NYSE and over time or more stocks closing up or down. Again, going through the end of July, sort of making a new high, breaking above the February peak. So pretty encouraging, but that's been it. We haven't had any follow through, and we actually have started to see this indicator rotate lower. The next panel down are the percent of stocks above their 50-day moving average. Just a couple weeks ago, this was up around 90%, meaning 9 out of every 10 S&P stocks were above their 50-day moving average. As of today's close, it's around 59%, which means about a third of the S&P was above their 50-day moving average a couple weeks ago and now is below it. So while the S&P is holding its own 50-day moving average, while a number of stocks are holding their 50-day, a bunch are actually not. They're actually breaking down, just like Apple and Microsoft and others that we've highlighted. So that line continuing to go lower, really any of these continuing to go lower, sort of further reinforces the downside move and the pullback, the potential for further pullback beyond what we've seen so far. The bullish percent index for the S&P 500 gave a key sell signal over the last week as well. When this indicator gets above 70%, what I found is that is a great confirmation that most stocks are going up using the point and figure methodology, because it's literally saying out of the 500 charts, what percent of them are bullish at any given on any given day. As of today, it's gone back below 70%. And if you look back at previous times when that has occurred, those have been the major pullbacks that we've seen over the last 12 to 18 months. And going back even further, you'll see that pattern repeats itself pretty consistently. So the fact that most point and figure charts were bullish and now we're starting to see less and less of that, again, this is an example of some of the breadth indicators starting to get less euphoric and more sort of a down-to-earth sort of reading. The last one is looking at offense over defense. It's been trending downwards over the last couple weeks, but still overall, consumer discretionary has done much better than consumer staples. When things get really squirrely, when I think it's really time to run for the hills to get defensive, that's when people think owning things like Hershey's and food products companies and cleaning products and household goods and alcohol and tobacco, when those are the stocks that are really starting to rotate higher on a relative basis that's when you want to get really concerned. We're not quite seeing that yet. You're seeing plenty of consumer discretionary stocks holding up, like hotels, for example, doing just fine here in recent weeks. So seeing a further rotation could be more of a negative confirmation. I don't think I'm seeing enough of that yet to really think more defensively using that particular approach. So the chart overall, as I would call it, really confirming the rotation lower. I think there's further confirmation to be had from some of these indicators to sort of identify a higher likelihood of a further pullback beyond what we've seen so far. Just to finish off here, I wanted to talk about a couple other things if I could. The AAII survey, we did a segment on yesterday's show called Getting Sentimental, which was fun. That was a segment we should do a little more regularly. It was fun to bring that one back. I hope you enjoyed sort of revisiting some of those sentiment indicators. We talked about the AAII survey, the Name Exposure Index, some of these surveys that actually help you understand how different buckets of the investor community are thinking about the markets at any particular time. We did get the most updated data today. I will say the level of bulls came down slightly, but it's still 45% bullish in the AAII survey. That's down from like 48% last week. The spread between bulls and bears down from around 29% to 19%. So you're starting to see a bit of a confirmation, right? Sort of the euphoric, everything's going up, to a little less optimistic here in the AAII survey, but still pretty elevated, right? These are still pretty bullish readings on that indicator, not sort of the world is ending. It's still sort of a pretty constructive type of reading. Just to finish off, one of the questions I got recently was on Tesla, and I think Tesla's an interesting chart. What do you do with Tesla if it gapped lower and kept going down? So what I will tell you is I think it's really important when you have a price gap to see what happens right afterwards. A lot of times you'll have a gap lower and then a bunch of buyers come in and they're thrilled to buy in on a short discount and they're able to ride the price back higher. And when that happens, that can be a pretty bullish sign. I think maybe an example of that is back here in April, right? You gapped lower, but then soon after you actually see signs of accumulation. You see investors coming in and willing to buy Tesla and push it to new swing highs. So far, that's not really what we've seen. We're seeing the opposite. We're seeing a gap lower be met with additional sellers. So people that missed that initial opportunity to sell are thrilled to keep getting out because they're expecting further downside to be had. Again, I would always define something like this with sort of the line in the sand of approach. So for me, I think this is an easy one to take the low from January, take the low from April and May. That gives you a trend line currently around 225, 230. We hold that, and that is a pretty consistent uptrend channel of higher highs and higher lows, sort of on the long-term time frame. We would break that sort of level. All of a sudden, we're talking about the 200-day moving average, talking about the stock potentially going below 200. That is where we need to think about higher likelihood of further downside potential. For now, the RSI is still kind of hanging in there, still in a bullish range. We're still holding a trend line off of those previous lows in 2023. I would be very keen to see if that kind of level would hold on a stock like Tesla, which had certainly been leadership not too long ago, about a month ago. We're talking about Tesla making a new swing high. Now all of a sudden gapping lower and continuing lower. I would also tell you within that same space of automakers, got a lot of pain this week. I mentioned the intro, one of the groups within an industrial group. This is actually in consumer discretionary automobiles. You have GM and Ford both gapping, trading lower today. GM down about 5.8%. Again, what kills me about this sort of chart is that we've had a well-established resistance level and we've failed so many times to get above there. I'd be more excited about a chart like GM if it's getting above 41, getting above 42, getting above resistance. For now, it's pulling back further off of a well-established resistance level. That's it for our market recap. I want to bring on today's guest, Mish Schneider, here in a moment. Before I do, a couple quick announcements. First off, our mailbag is empty. It needs questions. Can you help us out? Email us your questions at thefinalbar@stockcharts.com, on Twitter, X, at FinalBarSCTV, on our YouTube channel. Just drop a comment below the video that you're watching. We'd love to hear from you. We hope to answer your question in our next mailbag on Friday's show. Also, as a reminder, we'll be doing our next YouTube live Q&A next week on Wednesday, August 16th, 1 p.m. Eastern. Mark it on your calendars. Save the date. We'll have an invite out over our YouTube channel very soon. But we hope you can join us. It's a great opportunity to have a different feel, be able to interact directly. You can ask questions live. We'll go through the charts and see what sort of questions you're coming up with through the course of the week. That's coming up next Wednesday, August 16th, 1 p.m. Eastern. I want to welcome on today's guest, Mish Schneider. Mish has been a frequent guest on the show. It's always a pleasure. She's the chief strategist at MarketGauge, coming to us from beautiful Santa Fe, New Mexico. Mish, good to see you. How are you?
Just great. It's August, though, and generally great time to go away. And I think the market is kind of reinforcing that feeling.
It feels like buyers are going away for now, right? On days like today, we see the rotation lower. I'd love to sort of get your take on where we're at. We had the CPI data this morning, initial rally, things are rotating lower. We're starting with your chart of the bond markets. Interest rates have been moving higher. Is there more to come there? What's your take?
Well, interesting listening to you before I came on. It's basically chart school. A couple of things you talked about that were really relevant to this chart. One is gap. So you can see all the gaps that we've had down since we broke those lows there at around 100, let's call it. And it's been straight gaps down without any kind of recovery until we reached the trough and we started to come back a little bit. But so there was some buying coming in. However, the other thing you talked about in your chart school sort of way is that there was an area of resistance that had to clear in order for that to be very convincing. And it was right around 97.35 to 40. And even today, it looked like it might challenge it after the CPI numbers came out. And of course, instead it reversed. And that is no surprise, really, to me in particular, because I'm looking at the fact that it's been underperforming the SPY for quite some time. And we're going to get back to that point in a moment. And if you look at the momentum down below, which is our other ACP plugin, it's broken down pretty much under everything with almost a chance of a mean reversion. But we know almost surviving an operation doesn't necessarily mean anything. So I think what we can do with the TLTs is assume a couple of things. Number one is, and I'm on X a lot, so I see the various points of view with CPI, which also relates to the bonds. There's a huge number of people who believe that the Fed is done raising the rates and the bonds have bottomed, and it's just a matter of time that they're going to not only announce a pause, but eventually pivot. And in that camp, people also believe the soft landing and that inflation has peaked. So the CPI today is a lagging indicator. And I think that's what the market told you. And that's what the bonds have told you, is that clearly it was a decline over the several months. But today we saw areas of inflation starting to pick up again with reasons that we can believe, particularly in oil and energy, that it may not be done. And so there's the other camp, right, that says, oh, the Fed is going to raise a couple more times and we're going to have higher yields for much longer because the Fed is really only focused on fighting inflation. And today's numbers are not going to give them any reason at all to pause. So I say in these camps, you can go nuts looking at them, or you can look at the chart. And this is pretty clear right now. We take out those most recent lows, there will definitely be more pain.
I love that way of summarizing it, right? We could debate whether the bull-bear debate endlessly, but at the end of the day, why not just look at the chart and see what it's telling? And I think with both stocks and bonds, you certainly saw that initial move today, but then by the end, sort of had a very different feel to it. You know, lower bond prices, higher yields certainly tends to have implications for growth. Talk to us about the QQQ. How does that inform your analysis of this chart?
Well, before I get into that, I just want to make one other point about bonds, because there is some silver lining. And that is that we use our risk gauges based a lot on what the performance is on the SPY versus the long bonds, on the junk bonds versus the long bonds. And as long as, even with the SPY falling, the bonds are falling harder, or the TLTs are falling harder, or the junk bonds are holding up against the long bonds, we can still, or the gold is falling against the SPY, we can say those three things are still right now, just to confuse us even more, saying risk on remains in the market. We have not seen signals of risk off yet. That leads us right into NASDAQ.
Yeah, that's a good point. And I think the stock to bond ratio is certainly reflecting what you just said, still kind of favoring stocks regardless here.
I'm sorry, if the TLT started to rally from here, I think I would get more concerned about recession than what you would read out there, that people are concerned about it. So there you go.
Got it. Okay, yeah, good point. Talk to us about the QQQ. Now testing, the 50-day moving average. Where are we at here? Where are we headed, do you think?
Well, now we added something new to the chart, and this is going to be launched on Stock Charts very soon. And I have been writing a lot about the July 6-month calendar range. So very quickly, we look at the calendar ranges 2 times a year, January and July. So I call this the second half of the year. And it's important because when we're looking at the NASDAQ right now, we had a couple of days where it cleared it right in the early part of July. But yet we have been underneath it with a gap, by the way, and we've not really been able to get back above it. So that tells me right now that not only are we seeing this as a correction, but it is possible, based on a few other indicators, that growth is kind of done. Does that mean we're going to crash and burn? No. But we would be looking now not only at the 50-day moving average, which it's sitting on as it's closed yesterday and even today, as the first, as you call it, line in the sand. But we'd also be looking at around 362, which is the 6-month calendar range low. And the reason why I'm so keen on these ranges right now, as we're in August particular, and even though low volume and obviously a lot of speculators gone for the summer, is that in January, just the opposite happened with NASDAQ and with SPY. It set up the 6-month calendar range in January. The NASDAQ took it out and never looked back, really, except for even the correction that we had in March. It did not break down under that January 6-month high. So now, if we break down under the 6-month calendar range low, I think that, along what we just said about bonds and how that impacts growth, would mean some trouble. But the evidence is still, the jury's still out, just exactly what you said. We don't really know yet. Now, in terms of the performance, it is underperforming SPY. And in terms of momentum, and here's where things could get better. It's sitting right on the Bollinger Band. That's sometimes ripe for a mean reversion. So if tomorrow we hold the 50, we start to see a little bit of an increase in momentum as we end the week. Again, it's possible that this was the correction, but I'm not going to say that one way or another. We really don't know yet. And if I had to make a guess, I would think lower, but that would be just a guess until the evidence is there.
Right. No, that's a really interesting take, and thanks for highlighting the new indicator. I know we're working up for ACP from MarketGauge. So if stocks, particularly growth stocks, starting to not work, bonds aren't working, they're going lower. What is working? China, perhaps. Let's talk through the FXI, where there may be an opportunity here.
Well, it's interesting. I haven't traded anything about China in quite some time. And so what really came to it, the bearings for me, is, again, the chatter on X and the experts and the analysts, some very bearish in China. It's over. It's going into major recession. They've lost control. The jobless rates on the youth are really high. The exports and imports, we know, just went down. They can't live without the United States. And yet, once again, the price looks very different. We had Alibaba came back with 14% growth in their sales, unexpected. And we know that China can print money all day long because, first of all, President Xi can pretty much make any decision that he wants, number one. And number two is they're not having the type of inflation that we're having here. And the two areas really where they went down, believe it or not, in their inflation numbers, in terms of disinflation that people have been calling, was pork and transportation. So not really going to be a big impact globally. But anyway, getting back to the chart. Just like we saw the 6-month calendar range high and low on Qs, we have it here in the FXI. And forgive me for my not so great drawing here. It may not be perfectly horizontal, which is why we can't wait for you guys to have the plug-in. But it flew for a minute there when they were doing some quantitative easing, and it looked like they were going to come in and add a lot of liquidity to the system, and then it came off. And that's why it's a line. It's not necessarily the only line. But when it did correct, look at that. It corrected right to the 200-day moving average. And now it's back sitting right on the 6-month calendar range high. So that's one thing. If it gets through this 29 level here, you might have a very low risk situation buy. And particularly if it can get back through today's high in that 10-day moving average, then I think you might have a reason to think, perhaps China versus the US is an interesting play, particularly as we move down a little bit to the leadership ACP plugin, you can see we're outperforming a little bit now on the SPY. And if you look at the momentum indicator, even though we did have a mean reversion sell signal, look how nice that was compared to the peak high that we had earlier in the month, in July, that is. Now we are actually holding on to the 0 line and the 50-day moving average, which, by the way, is a bullish divergence to price because the 50 is over the 200, where in the price, the 50 you can see there is still under the 200, looking like maybe it's getting ready for a golden cross. So I just wanted to point it out for two reasons. One is technically it may be interesting, and two is these lagging indicators and a lot of these analysts, especially this year, who are not looking at price but crunching numbers, have not necessarily been the best people to follow for making your investment decisions.
Mish, there's so many little great nuggets of technical analysis wisdom in there. And I love that discussion about what could happen at the end of the day, why not focus on the charts, and some clear examples of what's starting to work, what's starting to not work, and some levels to pay attention to. Mish, always a pleasure. Thanks for sharing some charts with us. Be well, stay safe there in Santa Fe. We'll talk to you again soon.
Thank you so much, David.
That's Mish Schneider. Mish is the chief strategist at MarketGauge, coming to us from Santa Fe, New Mexico. We mentioned some of the ACP plugins that we have from MarketGauge, some really interesting proprietary indicators, too, that we have already. A third one that we're working on just now, looking at the 6-month range and 1-month range. So look for that very soon on our ACP platform. And it's so interesting. What I love about charting, as Mish was saying, is something like China, whether or not you think it should work, whether or not we could debate why things are going up or going down, at the end of the day, is the chart going up? That should be the most important question you should be trying to answer. And that is what hopefully the Stock Charts platform, including ACP, can help you do. Great take there, as always, from Mish Schneider at MarketGauge. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're starting simple, looking at my daily chart of the S&P 500. I just, as I mentioned, got back from Las Vegas talking to friends at the Money Show. A lot of attendees from all over the U.S., which was a lot of fun. And one of the things we really talked about was this in my sessions, were this line in the sand of approach, right? When you have a market starting to roll over, don't worry about it. It should not be an emotional decision of, oh no, what if this happens, but what if it goes down to this, then what about that? When should I take action? I find it's really helpful when things are good, when a chart is going higher, think about where that stop might be, right? What level, what signal, what move would you need to see to, at the very least, revisit a long position you may have? I think for the S&P 500, focusing in on that level, for me, it's around 4430. Answer that question for yourself. What's that level you would be looking for? Use a chart like this to identify it. I think, again, we're still well above, or not well above, we're kind of just above the 50-day moving average. The last time we tested the 50-day in May, that was a launch pad to the next 6 weeks of higher prices. I look to see if we can bounce off of the 50-day again. It is getting very, very close as we're pulling back here. The momentum's still staying okay, but also another important factor to watch. Chart number 2, the name exposure index. Yesterday we did a segment getting sentimental. We dug into some of the sentiment data. One of the indicators we talked about was the name exposure index. This is a survey of money managers, and basically what is their exposure to equities? Long, short, leveraged long, leveraged short. Where is it at? 2 weeks ago, this indicator was just above 100%, meaning the respondents in aggregate were leveraged long to equities. As of today, it's down to 65%, which is a pretty significant swing from being leveraged long to actually being underweight, sort of the average weighting to equities that we've seen over many, many years of following this indicator. So certainly suggesting to me that here in the short term, you're seeing money managers lighten up on long positions and get more defensively positioned. We're seeing that most clearly, I think, in the price action as stocks are pulling back and then continue to go lower. Leadership names like Apple and Microsoft struggling to hold support. As we see more and more of that, expect this indicator to continue to lighten up as investors rotate away from a very long position in equities. Finally, I was running a scan for stocks making new swing highs and new swing lows earlier today. One of the charts that came up on the new swing highs list has been a consistent member of that list, Comcast. What's interesting to me is whether or not you think the broader markets are going up and down, whether or not you think we're in a corrective pattern or not, or what sort of wave we might be in. I have found following charts that are going up, following charts where the relative strength line is improving, meaning it's outperforming its peers, are always good ideas, regardless of the broad market environment. Charts like Comcast keep going higher, and recently we gapped up at the end of July. So far, we've continued to rotate higher. It's been treading water a little bit. Today, up about 1.4%, and I think putting in continued higher lows, being above two upward sloping moving averages, those are the signs of a chart in an accumulation phase. So nice move and continued uptrend from Comcast. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Mish Schneider of MarketGauge joining us from Santa Fe. Don't forget our next YouTube live Q&A coming up next Wednesday the 16th at 1 p.m. Eastern. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.